I'm Caroline Hyde at Bloomberg's world headquarters in New York.
And I'm Ed Ludlow in San Francisco. This is Bloomberg Technology.
Coming up this hour, the FTC is front and center. Federal regulators looking to block Microsoft's $69 billion acquisition of Activision Blizzard, saying the tie-up between the Xbox maker and the game publisher would harm competition.
Plus, the FTC has opened its campaign to block Meta's acquisition of a virtual reality company. We had the story straight from the San Jose federal courtroom.
And pressure builds on Elon Musk and his bankers. That's as they consider providing him with new margin loans backed by Tesla stock to replace the riskiest Twitter debt. We've got details of that later. But first, after scoop after scoop after scoop coming from Bloomberg, we've got to get to the macro markets for just a moment, because at the moment the S&P 500 is actually pushing higher. We've got a change of tune in terms of risk assessment. Why? Is it the jobless claims data that came in, just showing that actually data in terms of jobs is weakening somewhat? We are getting more people filing for claims. We are therefore seeing perhaps a rolling over and maybe a more cautious Fed going into that. The Nasdaq, of course, is where we see some of the money move. We've got the Nvidias, the Apples leading the charge. Ed, I know you'll do the micro as you always do so well, but we're up more than a percentage point. Basically, this is the best sort of day since November the 30th. Not backdated that long, but we are seeing the volatility index, the good old VIX index, a fear gauge, if you will, still languishing at about 22, many feeling that that fear gauge will have to push higher, will go back to the more 25-30 range. At the moment, perhaps this is just complacency within this market as we see the volatility just pull back. Flick it on. Is it volatility that's managing to avoid what's happening in crypto? Bitcoin actually now is getting a nice little rally in the last day. We're up about 2%. It's small relative to what volatility we're usually used to in the crypto market. But the OG of the crypto space is having a push up higher. This is largely, though, on the back of dollar weakness. This is we, again, just reassess where the Federal Reserve might go overall, Ed. And that means dollar weakness for the first day in about 5 days. Bitcoin on the upside having its best day in at least a month.
Yeah, it's interesting. We've been so focused on the news cycle and the headlines driving specific stocks, but we forget earnings season continues. Broadcom, really interesting. It kind of is bucking the trend still in the chip space. Remember, it did it last quarter. It had a strong quarter just gone and a fiscal first quarter outlook of $8.9 billion of sales, slightly above what the street was looking for. But the street likes it. We're up 2.6%. Remember, Broadcom does have chips that go into phones and consumer electronics, but also looking at data centers as well. Some areas that are holding up better in terms of the end products that a lot of these chips go into. We'll continue to monitor this, I think, Caroline, throughout the show in case we get commentary on the earnings call about what's happening out there, right? About some of the end markets that we necessarily don't talk about as much. But that said, there is individual pressure. Tesla continuing to basically face a flurry of headlines. I know we'll go through them in the show. The one overnight that we think is putting pressure on the stock is a cut in production hours in Shanghai, which is interesting. Datadog up 8% after a board member bought $13 million worth of shares, and then Microsoft Activision, the really big story here. Actually, Microsoft reacting positively to the idea that the deal may not happen because, of course, some investors may not think it's the financially best decision, but Activision Blizzard falling because the FTC did what we thought the FTC might do.
Yeah. They stuck to the promise. They're going tougher on big M&A, particularly in the tech space. Lina Khan, of course, promised that, and she follows through. Ed, let's dig into all of this in D.C. We want to follow the news. We want to get to where the regulators are looking to block that $69 billion deal. And, of course, it's all about a question of competition, whether or not it would be harmed by this deal. Leah Nyland has been breaking this. You had the scoop, Leah. In fact, before we got the announcement from the FTC, just talk to us about the reasoning behind this decision.
Yeah, it's really interesting. I mean, a lot of the focus in the Microsoft Activision deal has been on the console market, but the FTC said that it's actually not as worried about the console market as it is about where gaming might be going in the future, which is into subscriptions and the cloud. And they said that's a major reason why they have concerns about this deal is acquiring Activision is going to give Microsoft a great library of games that will give it sort of an insurmountable lead in these two sort of emerging markets, given that Microsoft also already has some advantages with its, cloud-based service, making it a little bit cheaper for it than other gaming companies to offer this kind of a service.
Leah, and yet, Microsoft have been trying to get ahead of this, been trying to do deals, a decade deal done, of course, just yesterday with Nintendo for access to Call of Duty. And we understand that they sat down with Lina Khan yesterday to try and explain their reasoning. It seemingly hasn't landed.
No, I mean, the FTC, particularly under Lina Khan, has been very, very worried about the sort of deals that the tech giants are doing. As you mentioned, today the FTC started its lawsuit against Meta over the acquisition of a virtual reality startup. The Microsoft folks came to DC. They had offered a lot of concessions. I mean, not just these 10-year deals with the other console makers. They had reached an agreement with the Communication Workers of America to offer labor neutrality if any of the gaming studios wanted to unionize, which they thought, the FTC would look kindly upon. They had also offered some conditions related to employment non-competes that they thought the FTC would like, and that was not quite enough to do it for them.
In the end, I guess, Leah, those conditions or offers that Microsoft made are academic, right? They weren't enough. What's the timeline from this point? Just because the FTC has voted in this direction, it doesn't mean the deal's dead. No, this is, they voted for an administrative complaint. That means that from here it goes to a trial within the FTC before the FTC's in-house administrative law judge. That sort of a process is going to take several months. Probably we would not have a decision, an initial decision, until next summer, next fall. And from there, Microsoft can still appeal several times. So this is by no means the end, and Microsoft says it intends to litigate. This is not the only regulatory approval they need. They still need approval in the UK and also in the EU are the two main other ones. And neither of those jurisdictions were going to make a ruling on this deal until at least the spring, March or April. So Microsoft is still going to keep forward with moving towards regulatory approval there as it tries to litigate here in the US. I kind of love this story because there's a process that happens, but there's also fighting talk. I saw headlines crossing the Bloomberg from Activision CEO, for example. What is their public position, the companies, about what they want out of this?
Yeah, I mean, both companies have said, we want this deal to close. We want this deal. We think it's good for consumers because it expands access to gaming in ways that they wouldn't have now through these cloud and subscription-based products. Right now, Activision does not have its games on any of these subscription-based products, and so obviously this would expand access. Both of them say that they're committed to fighting for now. The deadline for the deal isn't until next summer, so they'll probably have to look at it extending it because of the length of the FTC's process. But they might be willing to do that.
Bloomberg's Leah Nyland. Caro said it. Fantastic reporting. Thank you. All right, let's move on to San Jose, where federal regulators are opening their campaign to block Meta's acquisition of the virtual reality company Within. Bloomberg's Alex Barinka is down at the courthouse. She's been there all day long. What was the story of the day and how did things play out?
Yeah, so they started opening statements. Witnesses are starting right now. And the big story of the day is the FTC is trying to kind of push this novel argument uphill to prove that this deal could hurt future competition in the virtual reality fitness space. You were just talking about the Microsoft Activision, also looking at future competition. This is kind of a torch that FTC chair has been taking, saying, look, we need to get the regulations right now before a company has a monopoly. So they tried to make that argument. The FTC also laid out some really interesting evidence showing their case that Meta was building a VR fitness app internally, and they scrapped that. Actually, when Apple had some interest in the company they ended up acquiring, they scrapped that instead to acquire the company called Within. And in doing so, they basically took a potential future rival, that internal potential app that Meta would build, off the table, and that's what hurt competition. So some back and forth there on both sides in terms of what the two litigants are pushing for.
Talk to us about the back and forth from Meta's perspective. How are they trying to argue that, look, they weren't actually building something internally?
There was charts and there were words. They basically threw up an org chart saying, look, from Mark Zuckerberg all the way down the chain, it was a no at every step in terms of the effort to build this internally. It was only a brainstorming exercise. And then they realized that actually building this app internally, there were too many obstacles. It was too hard to do. So the best course of action was to go out and acquire. We also heard Meta's counsel, Mark Hansen, come out and say, look, this nascent competition argument the FTC is making, they think think that they have no evidence here and that it could have a chilling effect on any vertical deals in the future because companies might be afraid to go out and buy companies they don't compete with just because they're big, because the FTC might then get involved. So some real pushback there saying, look, the core of the FTC's argument is not true in terms of what they'll lay out over the next 8 days.
I think that's so important that you really bring the context more broadly here, Alex, because this isn't just also about the nascency of this particular type of technology, but also the nascency of Meta's own pivot into the metaverse. What does it mean for them, the fact that they've pegged everything on this space and they're being stopped from doing inorganic growth in it?
And Meta is a company who has pushed into new spaces through acquisition. We saw that with Instagram. We saw that with WhatsApp. So you can imagine that them going out and acquiring an app like this is meant to layer on top of their Oculus, which was also an acquisition headset, to move into this space. They are a year in to being renamed Meta after the metaverse, which is the virtual reality world that they're working on building. It is a strategy that Mark Zuckerberg has caught a lot of detractors coming his way. The stock is way down because of the money they're pouring into this. So this kind of test for them in this court, they say if the judge blocks this, if they award the injunction, they're going to walk away from this transaction. So pretty high stakes here for Meta in terms of what they're trying to build in virtual reality, which they say is not only the future of Meta, but the future of computing in general in the next generation of the computing era.
Alex Barinka, it has been so good to have you on the ground there in San Jose. We thank you so much. And look, Ed, we've got to break it down. We've got to go throughout the FTC's focus on M&A, and we can do that with a perfect guest, American Antitrust Institute President Diana Moss, down in DC. Diana, today just is emblematic of what currently it feels like the administration's focus on M&A, particularly within technology. We shouldn't be surprised. Lina Khan has steered us this direction. But what do you make of the doubling down from the FTC at the moment?
I think this is very much in keeping with the chair's promises and the Assistant Attorney General's promises to really take a hard look at the digital sector, and for good reason. You know, the digital sector has grown dramatically in the last 20 years. They are coming off an acquisition spree that peaked in about 2014. It is absolutely a growth by acquisition model as opposed to a do-it-yourself model. It's sort of the buy or build question. So with the digital business ecosystems, that is the name of the game. It is to acquire and grow largely through acquisition. And both the Microsoft Activision and the Meta within are really, really good leading examples of this growth by acquisition strategy and the competition problems that they raise because they are very large companies with dominant positions.
Diana, that word, competition, that's the bit that I think consumers, investors struggle to understand, or at least struggle to sympathize with the FTC with, right? Is the FTC doing this because it wants to foster competition? In other words, have many players in the metaverse, which, let's be honest, isn't a real thing yet, or they want to prevent monopolies? Or is it the same idea?
I think they're the same idea, right? The antitrust laws in the United States are designed to promote and preserve and protect competition for the benefit of consumers and workers and smaller businesses that might be trying to get a foothold in markets or expand in markets. Of course, that rationale, which is very consumer-facing and worker-facing and smaller business-facing, can run up against rationales for why companies might think they need to be bigger to innovate more or innovate more quickly and be more dynamic to ultimately bring new products to market and serve consumer demand. So there is a very strong tension there. But in the digital sector, I think the balances have tipped, as we've seen in these two cases, but also the DOJ's case in Google, the FTC's case in Facebook, and several state cases that there is a significant dominance problem in some of the leading digital tech players, and that competition really needs to be scrutinized very carefully. And M&A, of course, is one of the leading ways that these companies grow.
Diana, do you have any sympathy for Within in this instance with Meta and the startup Within? You know, one thing we've learned is, of course, that the metaverse is a nascent idea. It needs capital, you know, access to talent to grow and to continue. Are you worried that there will be an over-stifling of innovation if bigger tech companies aren't allowed to go out and acquire smaller companies?
So that's a really good question, and it comes up a lot in public discourse. What is the better pathway to innovation? Is it to encourage competition by smaller rivals, independent market players, and have them grow into significant market players that could then challenge these incumbent companies, right? The large digital techs. Or is it, and we do that through promoting antitrust enforcement, or is it to provide a pipeline or a feed of these startups and smaller companies into the big digital ecosystems, knowing that they will be acquired and claiming that that somehow will increase the ability of companies to increase innovation. There's a real tension there. But I think the balances have tipped. And for example, in the Meta Within case, the purchase of Within, which has this leading VR fitness app, Supernatural, takes out a really important source of competition in a market that already does not have very much competition. So we worry about that when you eliminate competition in an already concentrated market. In the Microsoft Activision case, that acquisition also eliminates important competition on the outside of a digital business ecosystem. And we worry about those acquisitions when there isn't already a lot of competition. So if you're in the camp where competition serves the interests of innovation, or in the other camp, which is we need big companies to acquire smaller companies to continue to innovate, that really frames out the debate.
It's also an interesting debate to be having as we head towards basically a real pullback already upon us in terms of VC funding, a real pullback in terms of the free money that we were all so used to. And I'm wondering, what ways do we tend to see big companies that are sitting on a ton of cash be able to foster innovation in the space they want to see grow, if it isn't just by trying to do deals and actually acquire them outright?
Right. Very good question. And again, the growth by acquisition model really serves as a funnel for a lot of the free cash that companies have. But I think you have to look a little bit deeper at the culture of the companies, at the way the digital ecosystems are structured with a platform, with lots of cloud technology, where we've seen lots of acquisitions in the last many years, but also these constellations of apps that exist in the ecosystem. That's a complex business model, and it's the value proposition, and it's really supercharged. So if you have market power in a platform or in cloud technology, all of those pieces of the ecosystem work together where market power can be leveraged throughout the ecosystem. And so that complicates the innovation story as well. And in fact, my supercharge incentives to buy smaller rivals, because by buying a new application like gaming content or VR app content, fitness app content, you're able then to connect that content to the platform, a platform, and to supercharge it with value with cloud technology. So it's a very complex business proposition. It's a value proposition, but also poses really complicated problems for antitrust enforcers in crafting complaints. But the ultimate concern, I'm sure, as you know, is that all of this gets locked up in a single ecosystem, which makes it very difficult for smaller rivals to get into those markets.
I think, Diana, we're just starting this conversation, and we'll certainly continue it in the weeks and months to come. American Antitrust Institute President Diana Moss, thank you. Coming up, Elon Musk under pressure as bankers struggle to find buyers for the Twitter debt used for the purchase of the company after the billionaire promised to turn around its finances. This is Bloomberg.
So Elon Musk's bankers are considering replacing some of the riskiest and therefore the costliest debt that he led on Twitter with new margin loans backed by Tesla stock that he'd personally be responsible for repaying. It's actually but one of three pretty big Bloomberg scoops surrounding Tesla today. And Ed, as always, you were behind a couple of them. Just run us through some of the other stories at play when it comes to Elon Musk.
Yeah, I mean, the debt burden's important, right? $1.2 billion of payments annually, so there's something had to give there. The other two are that Tesla's cutting production hours in Shanghai, so the market's a bit worried about demand in China, which is the biggest EV market currently. And the second, as we reported, the China chief at Tesla has moved to Austin to kind of get things going there, which is a really interesting time when everyone's questioning what is Elon Musk doing any given day with which company.
Yeah, and rumors swirl as to his leadership at all these various companies. And we want to get back to the reason that people think he's distracted, which of course is Twitter. And Sonali Basak was one of the bylines on this scoop that came out last night and just has continued to fascinate us today of the debt. Talk to us a little bit about how much pressure this shows that all of them are under at the moment.
Listen, the unsecured part of this debt is the part that the banks are most worried about. They had promised an interest rate of 11.75%, and we know that junky debt, risky debt, junk debt here has really gotten much more expensive for the banks to be carrying. So they could take real losses here because of that promised rate there. Remember, there's a benefit here potentially, and this is just a discussion that the bankers are really having here, for Musk to be doing this, and that one benefit would be to really start to lower that burden of that $1.2 billion worth of interest payments he would have to make annually.
Which is more than Twitter revenue, right?
Yeah, EBITDA last year, absolutely. So, you know, if you are paying more than you're essentially making, it is a very difficult burden to be taking on as you're trying to turn the ship around. Now, I want to shadow this a little bit with the scuttlebutt that's going on in Wall Street right now, why this matters so much. Because as the banks try to offload this debt, you have the buy side really negotiating just so hard to bring the cost of that debt down, because a lot of big firms would love to be buying this debt cheaply, 60 cents on the dollar, maybe less. The banks are like, no way is that happening in our lifetimes, hopefully. But because if they did that, they would have to take bigger and bigger losses. But the negotiation, if they were to sell this debt below par, which might happen, is one option. But the other option here could be these margin loans.
Yeah, well, the market's changed since April. Don't ask me what it's going to look like throughout my lifetime. Bloomberg, Sonali Basak, thank you very much. Coming up, no booze, no politics, and no competitors. We discuss the many advertising bans of the new Disney Plus ad model subscription. This is Bloomberg. Let's get to Disney's streaming service, Disney Plus, which has debuted its ad-supported service, coming with strict rules: no alcohol, commercials, no political spots, no ads from competitors, Caro.
Interesting, isn't it? Because it's about a month on from Netflix's ad-sponsored one. And they do have a beer ad, Ed.
Right, but they learned from their experience with Hulu, where they already have ads, just half as much now on Disney Plus. We'll be right back. This is Bloomberg.
...2021, against almost any measure, it was a record year, not only in terms of the amount of funding going to private companies, but the number of deals that were actually done. So we were moving at a pace of almost 100 companies being funded every day. In a lot of ways, it felt like there was too much money chasing, despite the fact that it was so many deals, too few deals.
Oh, where we were in 2021, Ed. CB Insights' Brian Lee there. And interestingly, actually, as we keep talking about the slowdown in VC funding at the moment, amid all the concerns, we actually learned that PhonePe today, it's the Walmart-owned digital payments brand, is actually seeking as much as $1 billion from the likes of General Atlantic and Tiger Global, Qatar Investment Authority, and Microsoft. So it seems that some deals potentially still getting done if you're the right size, right space.
Yeah, the headline is that the value overall globally, VC value deals down, right? But actually what we learned from the pre-Queen data, we learned from CB Insights in the last 24 hours, is that it does depend on geography. So in that case, that deal's in India. In China, the dollar value is down 50% in 2022 year on year. In USA, it's 45% according to pre-Queen. But those are just two markets. So the question, I guess, is where is money still flowing? Where's the opportunity? Which subsectors? And luckily, we can talk about this all week long if you like.
Yeah, we're going to keep on talking about it until the year is done, until the next year is through. But we've got the perfect guest to talk about it in the here and the now. It's Nizar Tahirni. He's with us, Director of Research at PitchBook, for more. And just talk to us about what you're learning at PitchBook, what you're seeing in terms of the great highs that we came from, what 22 and now looking into 23 is going to look like for VC checks.
Yeah, I mean, it's been truly an astonishing couple of years. And I think as you look forward over the next 18 months, I think the most important thing to do is actually look backwards and get a sense of what's happening over the past couple of years in the venture markets, which has in a lot of ways led us to where we're at today. And so if you think about the dry powder number, so money that hasn't been invested yet in vehicles, there's $560+ billion globally. And I think the narrative over the past couple of years was that even in the case of a downturn, you were going to end up in a world where there was enough money to help supplement the industry and prop it up. Yet if you pull that layer back a little bit and you take a look at what's happening under the hood of the fundraising numbers, what you see is the majority of that is actually in late stage vehicles. We've raised $1.5 trillion, right, over the last 5 years, and that's more money than we raised in the 20 years before that. And so you've had this enormous run-up of capital that's really bottlenecked. And so I think the story of venture today, it's actually a story of concentration. So when you have money raised in the late stage at that capacity, if you think about where it's going to go, it's going to have to flow into larger check sizes. And so over the last, call it 6 or 7 years, you've seen the median check size and the average check size literally triple.
Yeah.
And then if you think about where that money's flowing from a company size perspective, you've seen 46% of the entire market cap of venture capital effectively sitting in unicorn companies. And that's relative to 16% just a decade ago. And one of the things I think is really interesting is if you take the total value of unicorn companies and you run that against net asset values of the entire global venture market, that value is actually twice the size of the entire net asset value of venture. So what that tells you is that the money that's been flowing into these companies, it's not even coming from the venture ecosystem. And so what you've seen is that you've got corporates that are actually buoying a lot of these transactions and non-traditional investors. And I think today on a global basis, close to half of venture capital deals at the late stage are being led by corporates.
Case in point, like PhonePe, a Walmart-backed company, Microsoft's getting in there alongside traditional VCs like General Atlantic. Just talk to us, though, therefore, where all this money that is sitting there looking for a home is going to go. Are they going to start to spread out more thinly? Are they going to get more excited about the seed rounds once again? Or are they going to have to look for bigger, more assured deals in this sort of nervous market?
So what I think is most interesting about the dynamic today is that it's not like there's an incredible amount of money that's ready to be deployed. I think the pace of investments in the venture ecosystem was masked a bit by capital that was coming from non-traditional ventures and corporate balance sheets. And so I think today what you're going to see is a shift, probably not in terms of opportunity sets, in terms of how fast money gets deployed to the ecosystem, but I think you're going to see people look for complete different dynamics within the balance sheets and the capital structures and the management teams that they're investing in. And so you might still have early stage rounds, mid stage rounds, late stage rounds, but that capital is not going to come to market unless those companies can actually put that money to work efficiently, and they're going to look for signs of that. So I actually don't think over the next 12 to 18 months you're going to find people shifting their investment strategy to deploy into different sectors or areas. I think it's going to be shifting in the operational capacity of the teams and the ability to manage capital at scale.
Nizar, one of the questions we've been asking is about valuations, right? And there's a lot that's top of mind right now. Higher rates, cost of capital. How do you justify valuations for private companies? They've come down. But I guess that when you're a venture capitalist and you look at the NASDAQ 100, for example, you see that the NASDAQ 100's performance year to date and some of the peers of these private companies, how are we valuing growth companies? How are we valuing and benchmarking what's out there and those companies that are still yet to go public?
Yeah, I think it's a great question and one that a lot of people are trying to figure out right now, because I think the pace at which private companies are marked down tends to lag what we're seeing in the public markets right now. And I think that creates a lot of noise for the limited partners that are trying to invest in net new funds, because they're trying to get a sense of truly what those marks look like relative to the public markets. You know, one of the things we talk about at PitchBook quite a bit is that in times of market distortions or of excess, what we've seen over the last couple of years, every sleeve of the market tends to operate in its own little silo, whether it's Series A, seed, late stage, et cetera. And I think what you're seeing today is that the markets are actually operating relatively similar, and they're taking their cues from each other. And so the chart you just held up, you look at our venture-backed IPO index down 60+% relative to a NASDAQ, it's down 30%. If you were to pull out the SaaS companies of that index, for example, and you were to run a sales number for each of the aggregate of those companies in that index, and then look at the price to sales multiple, you would have seen that gone from 53 times to 3 times today. And then if you were to look at that index for companies that actually had any free cash flow and ran the same exact metric of price to sales, you would see those companies trading at 22 times. And so the market is telling you effectively that we need profitable growth, and a unit of ARR is not worth the same without free cash flow to justify it. And I think what you're going to see is that those companies are going to end up getting follow-on funding, and their marks are going to be higher on a relative basis. And then those who don't have that, I think you're going to see the valuations decline precipitously.
So, Nizar, I'll go back to what Caroline and I were discussing at the beginning of the segment, right? The high bar set in 2021, and that not all markets are created equally. We actually asked our audience, what does 2023 look like for startups in terms of fundraising? These are the results. Almost 50% bleak. Almost 50% depends on sector and size. Nizar, bleak or depends on sector and size?
I think it depends on sector and size, and I think the gap between bleak and non-bleak is going to be a lot wider for a lot of companies.
All right, Nizar Tarhouni, Director of Research at PitchBook. Thank you very much. So here's another story we're watching. Peter Thiel placing a $250 million bet on a venture debt fund. The venture debt firm Tacora Capital was started this year by Kerry Finley, a former partner at well-known Third Point. It targets private companies in industries like property technology and fintech with predictable cash flows and assets that Tacora can use to actually underwrite the risk. It is an unusually large investment by Peter Thiel's standards, the size of which has not yet been previously reported. I think what's interesting about this, Cara, is I've come across venture debt in the past. I've done a few stories over the years where it's included alongside a traditional venture equity investment. But usually what happens is the venture debt party will say, oh, we're confident in lending this money to you based on the money you raise in the future to pay us back. Well, right now, think about what we've just spoken about. That seems a little bit of a hairy proposition.
Yeah, and I think a lot of people are being attracted. Well, the companies are being attracted if they need money to go the debt route because they don't want to be having to mark down what the valuations are from an equity perspective. And I think this is really speaking to, well, PitchBook's entire point, and the idea that perhaps people are just going to have to think that much more creatively in the ways in which they want to invest. Yes, it's like what different ways in which is the money going to be operationally used, but also which bit of the capital structure do you want to be in, and just more thoughtful about the way in which you're going to put your money to work in this space. I think it's really interesting that, what is it, 250 million coming from Peter Thiel, but there's 100 million alongside that. And clearly, Kerry, she's got a lot of experience in this space.
Yeah, and also global. Look around the world, not just US and China. I think that's the story of this week. Yeah, here's hoping. Sadly, I'm not hearing all that much about being deployed in Europe right here, right now. But let's talk about some other areas in which perhaps the money's actually been drying up a little bit. And remember, Ed, how excited we got in the world of esports, how much we thought the industry was going to boom, how much celebrities and people were really diverting some of their funding towards this space. And now actually the sources we understand are actually dwindling. The signs pretty abound that athletic competition via video games doesn't really have anywhere near the earnings potential that investors had originally anticipated. And we want to therefore go to a great story on the terminal.com that you can read today, done by Cecilia de Anastasio, of course, who is here with the insight. And Cecilia, talk to us about the deep dive you've done, the money, the sheer wall of money that went towards this space pre-COVID. Then COVID suddenly sort of shut down all these gatherings of together where you'd watch the esports unfold. But then it ticked back up. What's sort of going wrong in this space at the moment?
Sure. So $4.5 billion was invested in esports in 2018, a lot of which was from sports business billionaires who believed that esports could one day scale on the level of maybe the National Basketball Association. But over the last couple of years, esports organizations who field teams for these competitive leagues have had trouble becoming as profitable as many had hoped. Part of that was due to COVID, due to lockdown restrictions that prevented fans from watching esports live at at stadiums, but some analysts say that actually this is something that's masking a greater problem in esports, which is the challenge of structuring a business that allows a company to turn a profit off of IP that publishers ultimately own.
Talk to us about where perhaps money is still, from a fledgling perspective, going. Where people are still seeing opportunities in esports, but it feels like it's more individuals, right, rather than teams.
Sure. So esports players are earning large salaries playing competitive gaming. A very small percentage, though. So if your kids are thinking about it, tell them that there are slim chances. 6 and 7 figures are going to top esports players in games like League of Legends. Gaming publishers are also earning some amount of money from esports ventures through franchise fees. So teams that do decide to field esports teams in their leagues might offer payments as large as $20 million to participate.
I've been in a few cities. I think it was Vegas. Anyway, I flew into a city and there's a stadium there, right? And you ask around, what's the stadium for? And then they turn around and say, oh, it was built for esports. But now they're not being used. I know that's not necessarily the technology side of the story. It's almost the tragedy of the story. So what is the future of all of those stadia that were built to house these great tournaments with thousands of screaming fans watching some people play on controllers?
Sure. So I recently attended an esports tournament for the League of Legends Championship Series in New York, and it was so fun, and it was packed, and people were buying merch and screaming and having a great time. But it was in Hulu Theater, which is not a dedicated esports arena. There are dedicated esports arenas that were being constructed. There was one by Comcast Spectacor in Philadelphia for the Overwatch League team Philadelphia Fusion. But unfortunately, developers decided to pivot it into a multi-use arena over COVID. Part of that, of course, could be because, of challenges related to lockdowns. Another part, of course, could be the fact that, esports fans on average spend just about $5.30 a year on their esports fandom, which is tiny compared to sports fandom. And sports arenas do receive government subsidies and esports arenas do not. So the finances there don't necessarily weigh out in everyone's favor.
Cecilia, it's a brilliant read, and we've loved being able to dissect her a little bit more with you. Cecilia, to Anastasio there, we thank you. Meanwhile, coming up, well, we got to do it. FTX, the drama, it continues to unfold. Of course, there's the new CEO and the bankruptcy lawyers, they're set to be meeting with federal prosecutors. What's interesting, though, is some people are seeing some money to be made in this space. Sylvia Jablonski is among this, of Defiance ETFs. Let's talk about her short ETF that she's developed. This is Bloomberg.
While FTX and many other, frankly, crypto-related companies are feeling the heat, Defiance ETFs has been benefiting from turmoil in the cryptocurrency industry, with its daily short digital economy ETF soaring more than 20% since its inception this September. Defiance ETFs CEO and CEO, I'm pleased to say, Sylvia Jablonski joins us now to discuss. Can we start with the basics? What is the ETF? And then we'll get on to why is it benefiting?
Sure. Thank you so much for having me. So what our ETF does, IBIT, is it gives investors access to the inverse performance of some of the stocks that are correlated to or best represent the crypto ecosystem. So for example, stocks like Coinbase, Galaxy, MicroStrategy, Block, Robinhood, these are names that are highly correlated to the price of Bitcoin, for example, and really popped when Bitcoin popped over the past year. But since Bitcoin has fallen from 70,000 to where it is now, these names have fallen in tandem along with the overhang of macro risk. So a lot of traders out there know about short currency Bitcoin funds, and they get their exposure that way. But at Defiance, we thought, well, there's a much bigger picture here, actually, because there's so much contagion between equities that are related to crypto and really benefit from and generate revenues from crypto as it rises. So if that's going the other way, there's got to be a product to capture the short there, and that's what we're trying to do.
Okay, so what happens if the market takes a pause and we, over a longer term period, start to see both crypto-related equities and just more broadly digital assets rebound?
Yeah, so in that case, so what you want to do is you want to look at a fund like IBIT when you have the view that markets are going to fall, or when you're looking to hedge your position. So if crypto starts to rebound, you can think about it as a hedge to have in a portfolio, or you can transition to another ETF like an NFTZ, for example, that is long all of those types of companies as well. So there are a few crypto ETF products out there. There are single stocks out there. Obviously, the investors can get back into like Coinbase and Robinhood, whatever they sort of like if their view is changing. But the point is that, you sort of have tools that represent both sides of the trade. And that's really what we're striving to do, is to give investors access to those products. And, they're typically hedge fund types of products. So it really democratizes this for the average retail trader who we know is highly interested in crypto.
And luckily, a lot of these are therefore publicly traded companies, publicly regulated companies. And I'm interested, though, Sylvia, what demand has been like for long the sector. You're someone who speaks much about where assets currently are trading, where they should be trading. You often take a view. From your perspective, are people about to expect some sort of pop back in some way?
Yeah, Caroline, and actually you just made a really great point there. So the other, benefit of looking at shorting equities versus just shorting a cryptocurrency itself is that it's going to take a lot of these companies a while to recover. So even if crypto starts to inch up, until the broader market recovers and tech recovers, companies like Coinbase, Robinhood, Galaxy, the companies we mentioned before, they're probably going to have a lag to crypto itself too, just because of the overhang of inflation and rates and things like that. So I think we have some time on this trade. In terms of investors coming in, absolutely, right? I mean, the time for value creation is when markets are dismal. But I think that because of FTX, and you started this, in the intro there, because of FTX, there's so much sort of apprehension to get back into the sector for some of the retail traders that dove in heavily until we get some regulation, until we get some clarity around, crypto and how the end investor is protected. So I do think that it's going to be a slow roll on this. Longer term, I'm fully bullish on blockchain technology, digital assets, and tokenization. But I do think in the short term that it's going to be a little bit tough, and you might benefit more on the short side than you will on the long side.
Sylvia, are you a bit worried about the lack of new ways in which to gain exposure from a regulated perspective?
I'm not. There are actually a lot of good ways to gain exposure, but they're not all cost efficient. So I think looking at a short equity fund is a good way to do it. Obviously, the way we're kind of going about it, because you just buy an ETF long in your account, right? It's as easy as can be. In terms of the short futures funds, as long as there's sort of enough supply to build the fund and rebalance it on a daily basis, and you have clarity and transparency on what's in the actual fund, how much of it is actually short Bitcoin, and how much of it is, sort of filled with something else. You want to make sure you're getting pure exposure. I think that's important. And there are two really great options out there. And then I think investors can also short single name stocks if they'd like to. But I think, the broader picture about will, products be approved in terms of an Ether ETF or, some of the different types of cryptocurrencies out there. I think that this is just my sense that regulators might take some pause just because of what's going on with sort of the FTX issue. And they might seek to kind of come up with some rules and stabilize the industry before, kind of approving the more nuanced products.
Sylvia, it's always so great to get your perspective. Sylvia Jablonski, of course, of Defiance ETF. See you soon. Meanwhile, we've got to talk about it. It's going viral. WNBA star Brittany Greiner, finally free. More on that next. This is Bloomberg.
This is a day we've worked toward for a long time. We never stopped pushing for her release. It took painstaking and intense negotiations, and I want to thank all the hard-working public servants across my administration who worked tirelessly to secure her release.
President Biden there on the release of Brittany Greiner. Now, this is, of course, going viral wherever you look. The WNBA star being released from detention in Russia after the U.S. swapped her for Victor Bout, a so-called merchant of death, an arms dealer that Russia has been working for years to free. Now, Greiner has been sentenced to 9 years and moved to a penal colony last month. The Phoenix Mercury basketball star, who played in Russia during the off-season, pleaded guilty to drug smuggling in July after customs officials found vape cartridges containing cannabis oil in her luggage at Moscow airport. back in February. It has been a long journey, Ed, and therefore
Right.
really reminded everyone how important this story is,
Yeah.
no matter where you were on social.
Look, to hammer home the point, I've got Google Trends up on my screen. Brittany Greiner is #1 by a factor of millions in terms of what people are searching for this Thursday. Everyone around the globe has been tracking this case. And it's not the first time, I think, that she's actually been high up the charts on Google, Caro.
Yeah, what is she? The 7th most sought after or searched for athlete
Right.
of 2022, I think the numbers say. And also, there was a great video, I think, that you sought out from, well, a local sports team near you.
Yeah, Steve Kerr. Yeah. Everyone's talking about it. That's what matters.
It does. That does it, of course, for this edition of Bloomberg Technology. Go talk about us, huh?
Yeah, don't forget to check out our podcast wherever you get your podcasts, Apple, iHeart, and Spotify. This is Bloomberg.